What if the biggest thing keeping most people financially stuck is not their income, not the economy, and not a lack of opportunity, but the psychology they were conditioned with long before adulthood? Because if two people were given the exact same amount of money today, there is a strong chance that years later one of them would have transformed their life completely, while the other would have lost almost everything and returned to the same financial position they started from. And the difference would not primarily be intelligence. So let's find out what is the main reason. It would be mindset, emotional conditioning, habits, identity, and behavior. Most people think money is purely mathematical: earn more than you spend, invest consistently, and wealth will eventually grow. But human beings are not rational financial machines. Every financial decision is deeply emotional and psychological. Behind every purchase, every risk, every fear of failure, and every financial habit exists an invisible system of beliefs developed over years of experiences and conditioning. Wealth is psychological before it becomes financial. Behavioral economists spent decades studying how people behave around money, and their findings changed the way psychologists understand financial decision making. One of the most influential discoveries came from prospect theory, developed by Daniel Kahneman and Amos Tversky. Their research showed that people experience the pain of losing money much more intensely than the pleasure of gaining the same amount. Losing $100 hurts emotionally far more than gaining $100 feels rewarding. That single psychological bias silently shapes millions of lives. It explains why people stay in jobs they hate because uncertainty feels dangerous. It explains why many avoid investing, entrepreneurship, or career risks even when those opportunities could improve their future. To the brain, financial uncertainty often feels emotionally threatening, and over time, avoiding risk starts looking like personality. But these patterns usually begin much earlier than adulthood. Long before people understand economics or investing, they develop emotional relationships with money. Childhood experiences play a major role in shaping financial identity. Children absorb beliefs from their environment constantly. They hear conversations about bills, observe stress around money, and watch how adults react to success, failure, and scarcity. If someone grows up hearing phrases like money is hard to make, rich people are greedy, or people like us never get ahead, those ideas slowly become subconscious beliefs, and subconscious beliefs eventually become behavior. Someone raised around financial instability may unconsciously associate money with stress and anxiety. Another person raised around financial stability may associate money with security and possibility. Over time, the brain begins treating these emotional patterns as normal. This matters because the human brain values familiarity more than happiness. Even painful situations can feel psychologically comfortable when they are familiar. That is why many people unconsciously repeat destructive financial patterns throughout adulthood. They sabotage opportunities, avoid planning, overspend, or fear success itself because struggle feels emotionally recognizable. This leads to one of the most powerful ideas in financial psychology: the identity ceiling. Human beings naturally behave in ways that match their self-image. If someone internally believes they are bad with money, average, or not meant to become wealthy, their subconscious behavior often reinforces those beliefs, even when opportunities appear, even when growth becomes possible. People frequently sabotage progress the moment life starts improving. Someone receives a raise but immediately increases unnecessary spending. Another person starts a promising business but procrastinates important decisions. Others quit right before breakthroughs because success creates emotional discomfort. Growth challenges identity, and identity is psychologically powerful. Financial stress itself also changes brain function. Researchers studying scarcity psychology discovered that poverty consumes mental bandwidth. When people constantly worry about bills, debt, survival, and immediate problems, their cognitive resources shrink. Long-term planning becomes harder, impulse control weakens, strategic thinking decreases. Financial stress does not only affect money, it affects cognition itself. This creates what psychologists call the scarcity trap. The condition of poverty reduces the mental capacity required to escape poverty. People under chronic financial pressure often focus on immediate relief because survival mode narrows attention toward short-term needs. At the same time, research on mindset shows that beliefs about personal growth dramatically influence behavior. Psychologist Carol Dweck introduced the concept of the growth mindset, which refers to the belief that abilities can improve through effort, learning, and adaptation. People with fixed mindsets often interpret failure as proof that they are incapable. But people with growth mindsets interpret failure differently. To them, mistakes are information. Challenges become opportunities for development rather than evidence that they should quit. This distinction matters enormously because building wealth almost always involves discomfort. Learning new skills, taking risks, investing money, starting businesses, and changing habits all require uncertainty and persistence. Successful people are not necessarily fearless. Often they simply recover from setbacks faster because they do not attach failure directly to identity. Neuroscience also reveals something fascinating about ambition and motivation. Dopamine, the neurotransmitter associated with reward and motivation, activates not only when rewards are received, but when they are anticipated. The brain becomes energized by possibility. This means vision and goals matter psychologically. People who maintain a clear image of a desired future often become more motivated and more aware of opportunities connected to that future. However, positive thinking alone is not enough. Simply fantasizing about wealth can actually reduce motivation if it creates emotional satisfaction without action. Effective transformation requires balancing optimism with realism. Hope without action becomes fantasy, but realism without hope becomes hopelessness. Another major factor in financial transformation is environment. Human behavior is heavily shaped by surroundings. The people someone spends time with, the habits normalized around them, and the systems built into their daily routines influence outcomes more than motivation alone. This reveals something important. Financial behavior can often be redesigned by changing systems rather than relying entirely on willpower. Automatic saving systems, investment deductions, structured routines. These systems reshape behavior by changing defaults rather than demanding constant self-control. Over time, systems become habits, and habits become identity. This is where lifestyle transformation truly begins. Most people think changing lifestyle means expensive clothes, luxury cars, or appearing successful. But sustainable transformation is much deeper than appearance. Real lifestyle change happens when identity changes first. Someone stops saying, "I want to become wealthy," and begins saying, "I am someone who builds wealth." That shift appears small, but psychologically it is enormous, because behavior consistent with identity feels natural. Small decisions repeated consistently over years eventually create dramatic outcomes. Reading instead of endlessly consuming entertainment, saving instead of impulsively spending, building skills instead of seeking shortcuts. Most transformations look sudden from the outside, but internally they were built slowly through thousands of invisible choices repeated consistently over time. And perhaps this is the most important psychological truth about money. Wealth is rarely created by motivation alone. Motivation fades quickly, identity lasts. Before someone can consistently create and sustain wealth, they often must first become a different person psychologically. They must challenge inherited narratives about money, expand their self-concept, and develop the emotional resilience required for long-term growth. Because ultimately, the most important question is not simply how to make more money. The real question is, who must you become to build, sustain, and grow the life you truly want? What if the next 9 months could completely change the direction of your life? Not someday, not maybe eventually. 9 months. Because right now, millions of people wake up every morning already exhausted before the day even begins. They sit in traffic. They stare at screens for 8 or 10 hours. They wait for weekends that disappear in a blink. And deep down, they quietly wonder, is this really what the rest of my life looks like? And maybe you've asked yourself that too. Maybe you felt trapped between needing stability and wanting freedom. Because here's the truth nobody tells you. Most people don't hate working. They hate feeling like they have no control over their time, income, or future. And the good news? You do not need to win the lottery. You do not need rich parents. You do not need to become a millionaire overnight. Thousands of ordinary people leave their 9 to 5 jobs every single year by following a simple, structured plan. Not glamorous, not magical, just focused, consistent action. And so in this video, I'm going to walk you through a realistic 9-month roadmap to build income outside your job, create financial breathing room, and give yourself a legitimate path toward freedom, step by step. Before you quit anything, you need clarity. Most people say things like, I just want more money. I want financial freedom. I want to escape my job. But vague goals create vague results. You need a real number, a monthly number that covers your actual life, your rent, food, transportation, phone bill, internet, utilities, subscriptions, savings, everything. Because if you don't know how much income you actually need, you'll spend months chasing random opportunities without knowing whether you're making progress. That's like trying to drive across the country without knowing your destination. So here's what you do. This weekend, sit down with your bank statements and calculate your real monthly expenses, not your dream lifestyle, not your luxury fantasy, your real survival number. Then add 20% on top as a buffer for unexpected costs. That final number becomes your freedom number. For some people, it's $2,000 a month. For others, it's $5,000. But once you know your number, everything changes psychologically. Because now your goal becomes measurable. You stop saying, I hope things work out someday. And you start saying, I need to build this exact amount of income. That shift matters. Clarity creates momentum. This is where most people destroy their progress before they even begin. They try dropshipping, YouTube, affiliate marketing, crypto, Amazon FBA, freelancing, and content creation all at once. And within 2 months, they burn out completely. Listen carefully. You do not need 5 income streams. You need one working income stream, just one. The fastest path for most people is freelancing because it allows you to monetize skills you already have. And chances are you already have valuable skills from your current job. Maybe you can write, design, edit videos, manage social media, code, organize spreadsheets, handle customer service, do bookkeeping. You are not starting from zero. You are simply learning how to sell your skill directly instead of through an employer. And that mindset shift is powerful because the moment somebody pays you outside your job, something changes in your brain. You stop seeing yourself as just an employee. You realize, I can create income myself. That realization changes everything. Now, if freelancing isn't your thing, you can also choose digital products or content creation. But the key is focus. One path, one offer, one strategy. 9 months of concentrated effort will outperform 9 years of distracted effort every single time. The first 2 months are not about becoming famous. They're about building infrastructure. This is where you create the foundation that future income will stand on. And honestly, most of it is simpler than people think. You need a basic online presence, a LinkedIn profile, a portfolio, a simple website. Nothing fancy. Nobody cares about your logo color right now. People only care about one question. What problem can you solve for me? That's it. Then start talking about what you do. Post online, reach out to old contacts, join online communities where your potential clients spend time. And yes, this part feels uncomfortable because at first nobody responds, nobody likes your posts, nobody notices you. But understand something important. Visibility compounds. The people who seem established today usually spent months or years being ignored before momentum finally appeared. So stop waiting for perfect. Perfection is procrastination disguised as productivity. Launch the imperfect version now and improve later. Because action creates clarity far faster than overthinking ever will. This is the phase where things become real, because getting your first paying client changes your psychology forever. Your first sale proves that strangers are willing to exchange money for your skills. That's a huge mental breakthrough. Now, here's what most people get wrong. They wait for clients to magically appear. They post once online and disappear. That's not enough. You need outreach. Every week, send personalized messages to potential clients, not spam, real messages. Show them you understand their business and offer a simple solution to a real problem. And when pricing your work, remember this. A small paid project is infinitely more valuable than endless unpaid practice. A $200 project builds confidence, testimonials, experience, momentum. Your first 3 clients are the hardest. After that, referrals begin, confidence grows, systems improve, and suddenly the thing that once felt impossible starts feeling normal. By the end of month 4, your side income should ideally cover around 20 to 25% of your freedom number. And if it doesn't, don't panic. Usually the solution is simple: more outreach, better positioning, clearer offers. Business is often less mysterious than people think. At this stage, something dangerous happens: comfort. You finally start making money outside your job and your brain relaxes too early. Don't stop now. This is where momentum matters most. If you freelance, raise your rates. Seriously. Most beginners undercharge massively because they're afraid people will say no. But good clients pay for results, not cheapness. And if you're building content or digital products, this phase is all about consistency, not motivation. Consistency. The people who succeed long-term are rarely the most talented. They're the people who kept showing up after the excitement disappeared. This is where discipline replaces hype. And honestly, that's what separates dreamers from builders. Because motivation fades quickly, systems survive, create routines, automate savings, schedule focused work sessions, make progress inevitable. Because every repeated action is slowly shaping your identity. Now the finish line becomes visible. Your outside income may already cover 50 or 60% of your freedom number. And psychologically, this is where many people slow down. Because life already feels better than it did before, but this is exactly when you need to push harder. Double your outreach, improve your offer, build an email list, ask for referrals constantly, and most importantly, protect your finances aggressively. Cut unnecessary expenses, pause luxury spending, reduce distractions. Every dollar you stop wasting shortens the distance between you and freedom. And remember, freedom is not built through one massive moment. It's built through hundreds of small decisions repeated consistently over time. That's the real secret. Month 9. This is where preparation becomes reality. But leave intelligently. Don't quit emotionally. Don't burn bridges. Don't send dramatic resignation emails. Stay professional. Because your current employer could become your future client, referral source, or business connection. Now, before leaving, make sure your outside income consistently covers your freedom number for at least 2 months. One good month could be luck. Consistency matters more than temporary spikes. And build an emergency fund, at least 3 months of living expenses. Because financial breathing room allows you to make smart decisions instead of desperate ones. That stability matters more than people realize. But here's the truth nobody talks about enough. The biggest transformation during these 9 months is not financial, it's psychological. Because somewhere along the journey you stop thinking like someone waiting for permission, and you start thinking like someone capable of creating opportunities. That identity shift changes your entire future. Yes, the income matters, but the real victory is proving to yourself that your life is not fixed, that you are capable of building something beyond the path you were handed. And no, the process will not always feel easy. Your brain will doubt you constantly. It will compare you to people who became successful overnight. It will tell you you're too late. too inexperienced, too ordinary. Ignore that voice. Because the people who eventually build freedom are not superhuman. They simply started before they felt ready and continued. If you have $50 right now and you are under 18, you need to understand something before you spend it on clothes, games, fast food, or random stuff online. That $50 might look small today, but invested correctly, it could quietly become hundreds of thousands of dollars over your lifetime. And the crazy part is this: your age matters more than the amount of money you start with. A teenager investing $50 consistently can end up wealthier than an adult investing hundreds later in life. Yeah, that sounds unbelievable until you actually look at the math. So in this video, I'm going to walk you through exactly how a teenager can start investing with just $50. I'll explain where to open your account, what to buy, how to automate everything, and the biggest mistake that destroys most beginner investors before they even get started. And trust me, once you understand this, you will never look at money the same way again. Let's start with the most important concept in investing: compound interest. This is the reason people who start early have such a ridiculous advantage. Imagine three people. All three invest $50 every single month. Same amount, same investment, same average annual return. The only difference is when they start. Person number one starts investing at 16 years old. Person number two waits until 25. Person number three waits until 30. Now here's where things get insane. By retirement age, the 16-year-old ends up with hundreds of thousands of dollars more than the other two people. Not because they invested more money, not because they were smarter, but because they started earlier. Time did the heavy lifting for them. Your money starts making money. Then the money your money made starts making money. And over decades, that growth begins accelerating like a snowball rolling downhill. This is why investing is not really about getting rich quickly. It is about starting early enough for time to multiply your effort. Most teenagers completely underestimate how valuable their age actually is. At 16, 17, or 18 years old, you possess something more powerful than a high salary. You possess time. And time is the most important ingredient in building wealth. The earlier you start, the less money you actually need to invest overall. That is why someone who begins investing small amounts as a teenager can outperform someone making far more money later in life. Now, the first question most people ask is, okay, but where do I actually start? Step one is opening the right account. And honestly, this part scares a lot of beginners because investing sounds complicated. But today, it's easier than ever. If you are under 18 in the United States, you usually need a parent or guardian to help open what's called a custodial brokerage account. This simply means the account is managed jointly until you become an adult. Some of the best platforms for beginners are Fidelity, Charles Schwab, and Vanguard. These platforms allow you to start investing with very small amounts of money, sometimes even $1. And most importantly, they offer access to index funds and ETFs with almost no fees. Now, if you have earned income from something like a part-time job, tutoring, freelancing, lawn mowing, or babysitting, you may also qualify for something extremely powerful called a Roth IRA. This account is honestly one of the greatest financial tools available for young people. Why? Because your investments grow tax-free. That means decades of compound growth without paying taxes on the gains when you retire. Think about how crazy that is. You are essentially giving your investments 50 years to grow inside a protected account. That's why people who understand investing wish they had opened a Roth IRA when they were teenagers. Now let's talk about the next question everyone asks. What should I actually buy? And this is where most beginners make their first big mistake. They try to pick individual stocks. They see videos online telling them to buy the next Tesla, Nvidia, or some random trending company. But the reality is that even professional investors struggle to consistently beat the market over long periods of time. Instead of trying to predict the next big stock, beginners should focus on something much simpler and much safer. Index funds, specifically S&P 500 index ETFs. Now that sounds complicated, but the idea is actually simple. When you buy something like VOO, IVV, or SPY, you are basically buying tiny pieces of 500 of the largest companies in America all at once. Amazon, Google, hundreds of companies in one investment. So instead of gambling on one company succeeding, you are investing in the overall growth of the economy itself. Historically, the S&P 500 has averaged around 10% annual returns over long periods. Some years are amazing, some years are terrible, but over decades it has consistently trended upward. And that's important because investing success usually comes from consistency, not excitement. A lot of teenagers get distracted by high-risk investments promising fast money, crypto hype, meme stocks, day trading. And while some people get lucky temporarily, many beginners lose money because they chase excitement instead of building foundations. Real wealth usually looks boring in the beginning. It grows quietly, slowly, steadily, and then eventually the compounding becomes massive. Now, once you know what to buy, the next step is building a simple portfolio. The good news is that with $50 per month, you do not need anything complicated. In fact, simple portfolios usually outperform complicated ones because people are less likely to panic or constantly change them. A strong beginner portfolio might look something like this. Most of your money goes into an S&P 500 index fund. A smaller percentage goes into an international index fund for global exposure, and maybe a small amount stays in cash or savings for flexibility. That's it. You do not need 20 different investments. You do not need to constantly trade. You do not need to stare at charts every day. The biggest advantage young investors have is time. That means short-term market drops matter far less to you. And this is something beginners need to understand clearly. The stock market will go down sometimes. That is normal. There will be crashes and corrections, bad years, fear, negative headlines. But historically, markets have always recovered over time. The people who build wealth are usually not the people who perfectly predict crashes. They are the people who stay invested long enough for compounding to work. Now let's talk about one of the most important habits in investing: automation. This step sounds simple, but it changes everything. Most investing platforms allow you to automatically invest money every single month. You choose the amount, you choose the investment, and it happens automatically. This is powerful because it removes emotion from the process. You no longer have to rely on motivation. You no longer have to decide every month whether or not to invest. It simply becomes automatic. And automation solves two major problems beginners face. The first problem is inconsistency. People say they will invest later, then they forget. The second problem is trying to time the market. This is one of the biggest traps in investing. People constantly wait for the perfect time to invest. They wait for prices to drop. They wait for better news. They wait until they feel confident. But the truth is that nobody consistently predicts market movements correctly. Even professionals fail at this all the time. And missing just a few of the market's best days can dramatically reduce long-term returns. That's why consistent investing matters more than perfect timing. Small amounts invested consistently over decades outperform most emotional investing strategies. Now, there's another important setting every beginner should turn on immediately: dividend reinvestment. You may see this called drip on investing platforms. Here's what it means. Many companies pay investors small portions of their profits called dividends. It is leaving them alone long enough to grow. Most people interrupt compounding before it has time to work. They panic during market crashes. They sell too early. They constantly switch strategies, or they stop investing completely. Patience is extremely underrated financially. The people who become wealthy through investing are often the people who stayed consistent while everyone else became emotional. And this brings us to something important. Building wealth is usually not about dramatic moves. It's about repeated small decisions made consistently for a very long time. One investment probably will not change your life overnight, but years of investing absolutely can. That is why starting early matters so much. The earlier you develop them, the more powerful they become. Now, obviously, investing is not magic. There are risks. Markets fluctuate. Returns are never guaranteed. And you should always continue learning before making financial decisions. But historically, consistent long-term investing has remained one of the most reliable ways ordinary people build wealth over time, not because it's exciting, but because it works. So here's the simple plan. Open the right account, start with a low-cost index fund, invest consistently every month. Automate your contributions, turn on dividend reinvestment, and most importantly, give compounding enough time to work. That's it. No complicated tricks, no fake gurus, no overnight success promises. Just a simple system repeated consistently for years. And if you are watching this as a teenager, understand this clearly. You are earlier than most people. Most adults wish they started investing at your age. So if you have $50 today, do not underestimate what it could eventually become.
How did I achieve $1 million as a teen before the age of 25? Even before my teacher could do it.
At 19 years old, I made more money in 1 month than my teachers made all year. How can any teenager realistically become a millionaire before 25? Not through gambling, not through luck, and definitely not by waiting for permission. The modern economy completely changed the rules of wealth creation. For the first time in history, a teenager with a laptop has access to the same tools once reserved for massive corporations. You can publish content globally, sell products instantly, build software from your bedroom, reach millions of people without owning a building, a company, or even a degree. That sounds insane, but mathematically, it makes perfect sense. The reason most people never become wealthy early is because they still operate using industrial age thinking inside a digital age economy. They think wealth comes from labor. Today, wealth comes from leverage. And once you understand that difference, everything changes. For decades, society taught the same formula. Go to school, get good grades, get a stable job, work for 40 years, retire. The problem is that this system was designed for the industrial economy. Factories needed predictable workers, corporations needed obedient employees, and schools were optimized to produce them. But the internet broke the system. Today, one teenager with a valuable skill can outperform entire companies. A 16-year-old editor can make thousands of dollars per month working online. A teenager with an audience can build a 6-figure brand. A coder can launch software used worldwide before even graduating university. Meanwhile, most students spend their most energetic years preparing for a future that no longer exists. And this is where opportunity cost becomes dangerous. Every year spent only consuming information instead of building skills delays compounding. Because the earlier you start, the more time works in your favor. A teenager's biggest advantage is not intelligence. It is time. In the industrial age, wealth scaled slowly. If you wanted more money, you worked more hours. But digital systems changed the equation completely. Today, one piece of work can generate income forever. That is digital leverage. If you create a video once, millions can watch it. If you build software once, thousands can subscribe monthly. If you write an ebook once, it can continue selling while you sleep. The cost of reproducing digital products is nearly zero. Economists call this zero marginal cost. And this is the foundation of modern wealth. You are no longer limited by physical effort. You are limited only by skill, attention, distribution, and systems. The teenager who understands this early gains an enormous advantage over everyone still trading time for money. The internet also created something strange. Skills now matter more than credentials. Businesses are desperate for people who understand artificial intelligence, content creation, marketing, automation, software, and short-form video. And most older companies are years behind. That creates something called skill arbitrage. If you know something valuable that the market lacks, you get paid disproportionately well. A teenager who masters AI automation today may possess knowledge worth more than someone with 20 years of outdated experience. Technology rewards adaptability, not seniority. This is why many teenagers are quietly making more money online than traditional professionals. Not because they are geniuses, but because they adapted faster. Most people think becoming wealthy starts with investing. It does not, it starts with cash flow. Your first objective is simple. Learn a skill valuable enough that strangers will pay you online. That could be video editing. graphic design, AI systems, copywriting, coding, social media management. At first, the money is small. Maybe your first client pays $50, then $200, then $1,000. But something important happens psychologically. You realize money is no longer tied to location, age, or permission. And once that belief changes, your behavior changes too. Now you stop asking, how do I get a job? And start asking, how do I build systems? That shift changes everything. Now let's talk about the actual math. Because becoming a millionaire early is not magic. It is compounding. If a teenager begins investing early while continuously increasing income, the numbers become surprisingly fast. Imagine investing $500 monthly at age 15, then $1,500 at 17, $3,000 at 19, $5,000 at 21, and $10,000 by 23. At roughly a 10% annual return, the portfolio crosses $1 million near age 25. Most people hear this and immediately say, no 23-year-old makes $10,000 a month. Actually, thousands already do. Especially online. The real challenge is not earning. It is keeping and reinvesting. Because wealth is built through ownership, not consumption. That single idea separates people who appear financially free from people who spend their entire lives chasing money. The numbers are usually not the real problem. The real problem is psychology. Human beings are naturally wired to prioritize immediate pleasure over long-term reward. Behavioral economists call this present bias. The moment most people receive their first large paycheck, they immediately begin upgrading their lifestyle. They buy expensive clothes, luxury cars. Wealthy individuals think differently. They see money as a tool. Instead of asking, what can I buy with this money? They ask, how can this money continue working for me? That mindset changes everything. At the beginning, you work for money. Later, money begins working for you. This is why ownership matters so much. When you own assets, you create leverage. A normal job usually has a ceiling. There are only so many hours you can work in a day. But scalable assets operate differently. A YouTube channel can continue generating ad revenue for years. Software can continue gaining subscribers every month. A digital product can continue selling thousands of copies automatically. Investments can continue compounding silently in the background. They understand that short-term sacrifice can create long-term freedom. And this brings us to the roadmap. The key idea is simple. Build things once that continue producing value repeatedly. This is why many successful entrepreneurs focus heavily on creating systems. Systems create scalability, and scalability creates leverage. For example, a freelancer may make money only when actively working. But someone who builds a software platform can generate recurring income from thousands of users simultaneously. A creator with a loyal audience can launch products repeatedly without starting from zero every time. An investor can grow wealth through ownership of appreciating assets over long periods. This stage often requires a mindset shift. Most people are conditioned to think only about income. But wealthy people think about equity. They think about ownership percentages, assets, distribution, scalability, and long-term growth. This is the difference between temporary income and lasting wealth. The third phase is scale and compound. This is where financial growth begins accelerating significantly. Now the focus shifts toward optimization and expansion. The goal becomes increasing efficiency while continuing to reinvest profits. Income gets redirected into investments. Profits get reinvested into businesses. Assets begin producing additional assets. And compounding starts becoming visible. At first, compounding feels slow. The early years rarely look dramatic. But eventually, growth becomes exponential. This is why many successful people appear to become wealthy suddenly. From the outside, it looks fast. But in reality, the foundation was usually built quietly over many years. The teenager who becomes financially successful at 25 often started learning skills at 15. They spent years building knowledge, systems, relationships, and experience before the results became obvious. This is also why patience is so important. People want immediate success, immediate recognition, but wealth creation usually rewards consistency more than intensity. Small improvements repeated for years become enormous advantages later. One useful skill learned today may create opportunities years into the future. One investment made early may multiply many times over decades. The earlier someone starts, the more powerful compounding becomes. And this is the hidden advantage young people possess. Time. Teenagers may not have large amounts of money initially. A long runway for growth. Every year spent learning valuable skills early creates momentum that becomes difficult for others to catch later. This is why starting matters more than perfection. They wait for confidence. They wait for certainty. They wait for permission. But confidence usually appears after action, not before it. The people who succeed are rarely the people who knew everything from the beginning. They are usually the people willing to begin before feeling fully ready. Will every teenager become a millionaire before 25? No. There are real risks. Market volatility exists. Businesses fail. Economic conditions change. Competition increases constantly. Success is never guaranteed. For the first time in history, a teenager with internet access can build skills, reach global audiences, create digital products, start businesses, and invest in assets directly from a laptop.
Most students believe university is supposed to be financially painful. You study all day, work exhausting part-time jobs at night, and somehow still struggle to survive. But over the last few years, something changed. A new type of student quietly emerged. Students making money online while studying full-time. Students building freelance businesses from their dorm rooms. Students monetizing skills before even graduating. And the scary part? Many of them are making more money than graduates already working full-time jobs. So the question becomes, how are they doing it? And more importantly, how can an ordinary student realistically make $5,000 during the academic year without destroying their GPA? Because contrary to what social media tells you, this is not about hustle culture, it's about strategy. Most people view university as a 4-year intellectual vacation, a period of life where you are supposed to find yourself, make friends, attend lectures occasionally, and slowly transition into adulthood. And for a long time, that narrative worked. But today, it is outdated. Because the modern student is not operating in the same environment as even a decade ago. We are now in a situation where tuition is increasing, rent is increasing, and the cost of living is rising faster than most entry-level salaries. And as a result, a new category of student has quietly emerged, the professionalized student. Now, this does not mean becoming obsessed with money or turning your life into a constant hustle. That is the misunderstanding most people have. Instead, it means something far more structured. It means recognizing that university is not just an academic system, it is also an economic ecosystem. And inside that ecosystem, students are constantly making decisions that either build future leverage or waste it. Most students do not notice this at all. They think, I need a part-time job. But they never ask, what kind of job actually improves my long-term value? So they end up in low-wage service work, restaurants, retail, delivery apps, coffee shops. And while these jobs are not bad, they share one major limitation. They do not scale. You trade hours for money, and when your hours stop, your income stops. That is the fundamental problem. So in this video, we are going to break down a completely different system, a system where a student can realistically generate $5,000 during an academic year without destroying their GPA and without sacrificing their health or identity. And the key idea is this: stop thinking like a worker, start thinking like a system builder. For decades, student income followed a predictable path. You worked when you were free, you earned what you were paid, and that was it. But there is a hidden problem in that model. It ignores opportunity cost. Because every hour spent on low-skill labor is not just an hour of income, it is an hour not spent building higher-value capability. And this is where most students unknowingly lose long-term ground. Now contrast this with the modern internet economy. For the first time in history, students are no longer limited by geography. You are no longer restricted to local wages or local demand. A student in a dorm room can now access global markets. That means you can design for a client in another country, edit videos for a startup overseas, write content for international businesses, tutor students online globally, or build digital products that scale worldwide, all from a laptop. This is not a small shift. This is a structural economic change. Because now income is no longer tied to physical labor or location, it is tied to skill visibility, and that changes the entire equation of what it means to work as a student. Now let's break down the first pillar, skill arbitrage. This is the idea of taking skills you are already developing and selling them in a market that values them significantly more. But there is a deeper layer here that most students miss. Not all skills are priced equally. The market rewards clarity, specialization, and outcomes, not effort. For example, a student working a retail job might earn $12 per hour, but a student offering a specific digital service can earn $30, $50, or even $80 per hour. Now let's make this real. Imagine a computer science student. Instead of working a cafe job, they build simple websites for small businesses. A single website project might take a few hours, but can be worth hundreds of dollars. Now imagine a design student. Instead of random freelance tasks, they focus only on branding packages for startups. Now imagine a biology student. They summarize complex research papers into clean, readable reports for biotech companies or university labs. And here is the key insight. You are not working extra. You are compressing academic knowledge into market value. Now let's quantify this properly. At $50 per hour, you need 100 hours to reach $5,000. That is roughly 6 hours per week over a semester. Now pause and think about that. 6 hours per week is less than most students spend watching short-form content in a single day. Now compare that to traditional jobs. At $15 per hour, you need over 330 hours to reach the same income. That is 3 times the time investment. And that time difference is not just convenience, it is life structure. Because time determines stress levels, academic performance, sleep quality, and future skill development. So in this system, the real advantage is not just money, it is control over your time. Now we move to the second pillar, digital assets. This is where things become significantly more powerful, because freelancing still has a limit. You are still tied to time. So the next evolution is removing time from the equation entirely. A digital asset is something you create once and sell multiple times. Examples include study guides, Notion systems, revision sheets, productivity templates, AI prompt packs, coding tools, design assets, educational PDFs. Now here is the deeper idea. Most students are already doing the work required to create these products. They are already organizing notes, summarizing lectures, structuring information, building study systems. The only difference is packaging. Instead of keeping this knowledge private, you turn it into a structured product. And suddenly something important happens. Your academic effort becomes monetized. And unlike physical products, there is no inventory, no shipping, no production limit. One file can generate 10 sales, 100 sales, or even 1,000 sales. This is what makes digital assets powerful, not the creation, but the replication. And this is where students start to separate themselves from traditional labor entirely, because now income is no longer linear, it becomes partially exponential. Now let's talk about something most students ignore completely, the university itself. Most students think of university as an expense, but internally it is a resource system. Research assistantships, innovation labs, scholarship programs, startup incubators, pitch competitions. These are all forms of capital distribution, and most of them go unused, not because students are unqualified, but because they assume they are. A research assistantship does more than provide income. It gives you mentorship, experience, academic credibility, network access. And those benefits compound far beyond the immediate payment. Now let's bring everything together. A realistic student strategy might include freelancing income, campus income, digital products. Combined, this can realistically reach $5,000 over a semester. But here is the critical warning. Optimization has a cost, because it is easy to fall into overworking, and when students exceed 20-plus hours per week of side income consistently, something breaks. Sleep declines, grades drop, mental performance suffers. So the goal is not maximum income. The goal is sustainable structure. Because earning $3,000 with strong academic performance is far more valuable long-term than $5,000 with burnout. So here is the real conclusion. Making money as a student is not about grinding harder. It is about thinking differently. It is about understanding where value exists and positioning yourself inside it. Because university is one of the few environments in life where you have time, access, mentorship, and freedom to experiment. And students who understand this early do not just graduate with a degree, they graduate with leverage, skills, experience, momentum, and in the modern economy, that combination matters far more than grades alone, and if you really think about it. The biggest difference between struggling students and financially stable students is not intelligence, it is awareness. Awareness of how value is created, awareness of how skills translate into income, and awareness of how to position yourself early instead of reacting late. Because in 5 years, the students who started building even small skills today will not just be earning more money, they will have options. And in the real world, options are everything.